This video is for the nerds, at least the nerds who would like to hear about Tesla's hidden trillion-dollar opportunity that Wall Street's sleeping on, that retail investors are sleeping on, that the finance media is sleeping on, that just about everyone is sleeping on. As we know, it's never wise to sleep on Tesla's future potential. Hopefully this video can wake a few people up. Oh, and speaking of waking up, if you're ready to wake up and optimize your health, energy, recovery, and overall well-being, it's about time you tried Athletic Greens AG1, something I've been taking daily now for almost 2 years. There's a link in the pinned comment, or you can head to athleticgreens.com/SMR and get a 1-year free supply of vitamin D3 and K2, plus 5 travel packs. And a heads up to my Patreon supporters, if you haven't already seen, dropped 2 new exclusive videos in the past 24 hours. One of them extremely important. So let's get into it. If you want to follow along at home, there's a link in the description. Now we're going to skip the executive summary. You guys know what's going on here. Tesla's absolutely slaying it. The ICE vehicle industry is being disrupted. ICE vehicle sales are currently collapsing. The stock market hasn't quite figured this out, and that's why I'm continuing to bang the drum. First, some key risks. And you may notice a theme. A couple of these risks have nothing, repeat, nothing to do with Tesla's execution. First, some macroeconomic headwinds. Rising interest rates and a potential recession would hit the automotive industry particularly hard, creating demand or pricing pressures. This is true, keeping in mind, as I've said, a recession is the best thing that can happen to Tesla relative to anyone else on Earth who produces vehicles. While it is true, during a recession, many consumers were like, well, not buying a vehicle anymore, can't afford that, so I'm not going to do it. Those who still do wish to purchase a vehicle and will still purchase a vehicle are more likely to be thinking about costs. Purchase price, ownership costs, how much will I be out of pocket? Consumers are likely to be more discerning during a recession if they're going to purchase an automotive product anyway than if not in a recession. Additionally, a recession could cause massive deflation in Tesla's costs. And we know Tesla has insane pricing power. Just in case you've missed the recent happenings, after recent price cuts, Tesla has now raised prices repeatedly globally on most of their products. Tesla has the power to massively, and I mean massively, cut prices on every one of their products and still make industry-leading profit margins. So if the shit's hitting the fan, major recession, automotive sales collapsing globally, this is the best thing that could happen to Tesla. They will gain more ground relative to the so-called competition. The second thing that has nothing the fuck to do with Tesla the company or their execution, multiple compression. Tesla's PE has been re-rated down but is still significantly higher than other auto companies. Well, in fairness, they're not an auto company. Let's move on. In the short term, it is possible that Tesla could trade closer to an auto company than a growth/tech company. Now, this is possible. It's nonsensical, but it is possible. Let's just leave it at that. And finally, regulatory risk. Pushback on Tesla's FSD and autopilot program could limit upside potential or cause legal and regulatory hurdles. Now, in truth, I'm not actually expecting this to be a big deal. It's going to be a lot of noise about this. You know, the first fatal accident. Shit'll hit the fan, media will go crazy. But believe it or not, maybe I'm naive. I think most regulators will be more convinced by data than emotions. Tesla has logs, evidence, interventions, accidents per million miles, and so on. Tesla is building an absolute mountain of evidence to demonstrate the safety profile of their software versus human-driven vehicles. At some point in the future, when Tesla can demonstrate one of their vehicles driving autonomously is X times safer than the average human driver, I don't know what the threshold is, but at some point, 2 times safer, 5 times safer, 10 times safer. At some point, under the weight of this evidence, regulators will have to cave, even if they don't like the idea, emotionally speaking, of a self-driving, oh my god, it's so dangerous. Facts don't care about your feelings, and Tesla is accumulating some serious facts. When Tesla can prove, beyond a shadow of a doubt, here are the facts, here is the data demonstrating the safety profile of our autonomous software, a competent regulator will have a hard time arguing with the facts. Investment thesis. Strength of core business. Tesla has been revalued lower amid demand concerns, off-base demand concerns. There are none. The only demand concern is Tesla is unable to fulfill it with supply. Manufacturing prowess and the emergence of FSD as a financial contributor will ensure that Tesla maintains world-class margins. Energy business ramping. Analysts have historically ignored the energy side of Tesla's business, but Tesla Energy is about to undergo a step change in deployments and profits. This is true, important, and being widely ignored by just about everyone. Hopefully this video will change that for a few of you. Upside optionality. Tesla's best-in-class real-world AI capabilities can create massive upside potential in autonomy and robotics. Just in case you're new around here, it's true, Tesla is a financial juggernaut. Tesla's financial results over the last 3 years have consistently surprised Wall Street. And Wall Street's surprise at Tesla's unexpectedly good results over the last few years has not surprised me. Spoiler alert. This will not change for years to come, maybe the entire decade. Most of the time, Wall Street will underestimate Tesla. Not every time, but the majority of the time. Too many of these 150 IQ Poindexters just can't see, can't think. Tesla's stuck in a box. They can't see outside that box. They lack imagination. They lack creativity. They lack foresight. They lack the ability to look at all the pieces of the puzzle and then put them together and get a clear picture of the future reality. Skipping ahead a little bit, we know Tesla's printing a ton of money. More impressive has been Tesla's ability to stay lean as they grow and realize incredible operating leverage. True finance nerds, no question, every time they look at Tesla quarterly results, require a mop and bucket to clean up the mess. It is unbelievable how resourceful this company is. The report goes on. Tesla's financial metrics are truly astounding and give an indication of just how far the company's manufacturing prowess has come. It's informative to compare these figures to Toyota, a company which has long been considered the gold standard of automotive manufacturing. Just a few years ago, analysts were expressing incredulity at the notion that Tesla could reach, let alone surpass, the heights of Toyota's renowned Toyota production system. Many industry watchers believed at the time that Toyota's profitability level represented a ceiling which a newcomer like Tesla could only hope to aspire towards versus exceed. Tesla has not only met the level of profitability achieved by Toyota, but has blown clear past this level. This is even more impressive when you consider the results were achieved with roughly half of production coming from Tesla's Fremont factory, which will ultimately prove to be the company's least cost-effective facility. This is a very important point. In case you don't know, Tesla's Fremont factory, purchased in the wake of the global financial crisis for literally a penny on the dollar. Literally one of the best deals in corporate history. But this meant Tesla wasn't working from a clean sheet. They had to make do with what was there. The layout of the factory is inefficient as fuck. They're doing the best that they can, but because this wasn't a ground-up design, it's far less profitable per vehicle produced than the Shanghai factory, and the same will be true for Giga Austin and Berlin. The fact that Tesla can produce vehicles profitably at Fremont is excellent, but it is a massive drag on their overall profitability. As they say, a chart is worth 10,000 words or something like that. Best-in-class manufacturing, Toyota or Tesla? Tesla in red, Toyota in blue. Tesla's gross margin towering over that of Toyota, almost double. Operating margin, more than double. Net margin, probably more than triple. An amusing exchange here from a Tesla earnings call back in 2017. By the way, let me know in the comments below if anyone watching owned Tesla stock back in 2017. Brian Johnson of Barclays. Could you maybe give us some more discussion really on the managerial culture, the process level? A little bit of back and forth. Long story short, Brian Johnson suggesting that Toyota, their production system is the gold standard to which Tesla could maybe hopefully aspire to one day achieve. This was in response to Elon Musk pointing out that the most fundamental difference is thinking about the factory as a product, as a quite vertically integrated product. Brian Johnson then comparing that to Toyota. Yeah, like Toyota. Elon, yeah, we don't think so. Now, it's understandable that an analyst back in 2017 was somewhat skeptical of Tesla's ability to mass produce vehicles, but it's now 2023. And on the previous page, these blue bars were what Brian was thinking that Tesla was hopefully aspiring to maybe one day come close to, half a decade later, doubling, tripling, maybe even more than quadrupling some of these metrics. To be fair to Brian Johnson here, in 2017, who knows how things would have panned out. Market skepticism toward Tesla is nothing new. The market's incredulity that Tesla's goals to leapfrog Toyota's manufacturing efficiency seem to have parallels with today's skepticism of full self-driving. Indeed. Investors should not be looking backwards at historical financial statements, but forwards to the likely future position of a company. We believe that the take rate of full self-driving is likely to increase substantially in the coming years. And I think anyone with a brain would agree. It's getting better, even if you don't think Tesla eventually solves autonomy, which may require you not to think, period, but let's leave that to another video. We can see the improvement. Therefore, it is likely over time, as the software continues to improve, that more users will actually purchase the software package given the fact that it is more capable, better, offers more value. This has the potential to offer a further step change in profitability. An important point here, Tesla's fleet now, over 3 million vehicles with hardware 3 on the roads today, most of which do not currently have FSD. But the owner can at any time opt to buy or subscribe to FSD to enable the functionality on their cars. An example is given here. If just 10% of a 3 million vehicle fleet opted to upgrade, that would be nearly $5 billion of incremental margin on vehicles which Tesla has already sold. Tesla Energy, something many people are sleeping on. This part of the business is generally overlooked by most analysts and investors simply because the revenues and margins have been negligible when compared to Tesla's automotive business. Fair and true. By the way, guilty as charged. I'm still massively lowballing my Tesla Energy estimates in my valuation model, just giving myself a margin of error. While Tesla does not break out the split of its revenues and margins between solar and stationary storage, we estimate that storage revenues are roughly an order of magnitude larger than those of the solar business. And over on the right here, Tesla's historic deployments versus the Lathrop capacity. New factory, if you guys don't know. Annual storage deployments historically in red in 2020, 21, and 22. And the final capacity of the new factory, which, as you can see, is towering over Tesla's annual storage deployments historically. Once this thing is ramped up to capacity, holy fuck. No, seriously, holy fuck. Now on to the Megapack opportunity, or as I accidentally Freudian slipped, reacting to Tesla's most recent earnings, the Mega Buck opportunity. Tesla has had a substantial backlog of Megapack orders for about as long as a product has existed. And the reason for this is quite simple. In the commercial world, costs matter more than anything else. And those working in these companies, in these industries, who look at the economics, the cost, the viability of using a gigantic fuck-off battery to store energy, perform energy arbitrage, it is a literal no-brainer. Retail consumers buying a vehicle, they're a little bit slow to figure this stuff out. It's been known for some time now that over the lifetime of ownership, it's been cheaper to buy a Tesla Model 3 or Model Y than a Toyota Camry. Most consumers don't realize this because they just look at the sticker price. But when it comes to business, there are people whose job it is to use their fucking brains to look at the numbers and to save and or make money. Every one of these people who uses their brain sees an opportunity with the Tesla Megapack, does the numbers and goes, oh, okay, I would have to be a moron not to buy a few of these. Let's do exactly that. For the first time in its history, Tesla is no longer constrained by access to battery cells. Tesla's Megapack manufacturing process is ramping up with a dedicated facility in Lathrop, California, capable of manufacturing 40 gigawatt hours of Megapacks per year once it hits capacity. The 40 gigawatt hours of stated capacity at Tesla's Lathrop factory is roughly an order of magnitude more than Tesla has ever delivered in a given year. In fact, it's roughly on par with total worldwide deployments of stationary storage. Now this sounds familiar, doesn't it? You guys remember back in 2014, Tesla announced their Nevada factory, the battery factory, and at the time, its output once ramped in 2020 would be more than the entire world was producing at the time it was announced. Round 2. A single Tesla factory today in 2023, once ramped up in a few years' time, will be producing as much, if not more, than the entire Earth currently produces in stationary storage. Just one Tesla factory. At the time, everybody laughed and thought, there's no way they're going to make... Well, guess what? They did it. They're going to do it again. Don't sleep on this. At their Battery Day event in 2020, Tesla outlined a path to reach a staggering 3 terawatt hours of total capacity between automotive and stationary storage by 2030. In case you guys and girls are getting lost terawatt hour, gigawatt hour, it's very simple. 3 terawatt hours is 3,000 gigawatt hours. In other words, the fully ramped capacity of this new Megapack factory will be about 1/75th Tesla's 2030 goal of total battery production. This is a lot. Demand outlook. Bloomberg New Energy Finance estimates that cumulative storage deployments will grow 15 times between 2021 and 2030, and I estimate that their estimates will be massively off the mark to the downside. This total figure is lower than Tesla's stated goal, but the BNEF forecast for 2030 increased by 13% in just 1 year. Imagine that, expert forecast being wrong to the downside. That's definitely the first time that's happened. We believe industry watchers will continue to raise forecasts for future demand, and the ultimate winners will be those who can successfully ramp up capacity. Agreed. If you guys want a little bit more insight into the capacity, the potential demand for stationary storage, check out the work by Tony Sieber and Rethink X. I reacted to some of those videos, or just go check the sources. Just to orient you guys and girls around the chart here, extreme growth of battery interconnection requests. In other words, new battery needs to be connected, there's a request. This is a reasonable proxy for the number of new batteries being installed in terms of stationary storage. Notice the trend in blue here, to the fucking moon. When looking at the data presented in the chart above, it's clear that there is an absolutely staggering increase in storage requests. Indeed, in 2021, storage requests roughly doubled relative to 2020 and were up around 10 times from 2019 levels. You guys remember me banging the drum on EV adoption? When I first started the channel, global EV sales around 1.5, maybe if you're lucky, almost 2% globally. They're now like 12-13%, about a 10x in the span of like 3 or so years. People called me crazy, called me insane, not going to happen, you're an idiot, blah, blah, blah. The experts are only saying this. Round 2 for energy storage, the same shit. Everyone is massively underestimating how much demand there is for stationary battery storage, not only today, but in the future. And now for the Inflation Induction Act. A few key highlights. The EV tax credit, we all know, $7,500 per vehicle, depending on how corrupt the legislation is, whether or not they decide to continue considering Tesla's Model Y as an SUV, income thresholds as well. But this is a big boost potential EV sales. And also, as I've said, totally unnecessary. Even EVs will continue to sell if people make them. The government is pissing away money. It's unnecessary. EVs are already a commercial inevitability, but as a Tesla stock investor, hey, I'll take it. It's going to force Tesla to raise prices. We're already seeing this start to happen now. But hey, that also is a topic for another video. There's also a commercial EV tax credit. Tax credits of up to $40,000 for commercial vehicles like the Tesla Semi. Not bad. There's also an investment tax credit for storage. Stationary storage projects will receive a credit of 30% of the upfront capital cost, but this can reach up to 70% if the requirements are met for additional incentives. You did hear that right. And it gets even better. There's also the Advanced Manufacturing Tax Credit, which provides a credit of $35 per kilowatt hour for domestic cell manufacturing. And in case anyone's getting lost here, Tesla domestically manufacturing 4680 cells? Yeah. And $10 per kilowatt hour for domestic pack manufacturing. The example here for a 75 kilowatt hour Model Y built with domestic 4680 cells. This could translate to $3,375 in credits per vehicle. And again, as a Tesla investor, I'll take it. Hardware margin potential. Again, if you guys want to nerd it out, welcome to pause the video here. Just want to focus on some of the highlights. Most significantly, Tesla has pushed through a number of price increases on their energy business, on their megapacks, which have raised the price by nearly 70% to around $500 per kilowatt hour today. Previously, they were as low as $300 per kilowatt hour. Tesla's contract for megapacks now includes commodity cost pass-through language, which allows for the sharing of commodity price fluctuations, especially around lithium. In other words, if there is a huge surge in the cost of the materials going in the batteries in the storage products, Tesla doesn't get f***ed without consent. Everybody gets f***ed with consent, so they share the f***ing around between each other. Finally, Tesla has introduced a new product, possibly named after your girlfriend, Megapack XL, and a dedicated 40 gigawatt hour manufacturing facility in California. The increased size and implementation of a dedicated facility should allow for a streamlined manufacturing process. Assuming Tesla's improved efficiencies, net of material cost increase, have resulted in pricing in the $250 per kilowatt hour range. Gross margins of 50% are theoretically possible, or even higher by using Tesla's own data as well as third-party cost build-ups. While the number sounds unlikely, like many things in Tesla's future, we believe it is at least possible for Tesla to generate these margins once they work through the lower price backlog and fully ramp up the manufacturing facility. Currently, demand far outweighs supply, and Tesla has a tremendous amount of pricing power. By the way, this is going to be the story of the 2020s for Tesla. We believe this will lead to Tesla Energy EBIT margins peaking at around 30% in 2025. Additionally, scaling up total deployments by 10 to 30 times over the course of a decade could very naturally change the payback dynamics for end customers changing. Just as scaling up Tesla's automotive volumes by 50% per year requires average selling price decreases to sustain the total addressable market, the energy business will similarly need to reduce pricing to reach Tesla's terawatt-hour scale ambitions. We have assumed that pricing for storage products will decrease by 8% per year after 2025, reaching $303 per kilowatt hour by 2030. We further assume that EBITDA margins will decline as a result of this lower price, settling at 20% by 2030. Tesla's cost may well be even lower than this. Over on the right here, we're looking at cell costs by form factor and chemistry. If you guys want to pause, soak it all up, go for it. Long story short, LFP cylindrical cells are the cheapest by far, around $80 per kilowatt hour. However, Tesla's costs may well be lower than this, and with the $35 per kilowatt hour credit at the cell level, the margin potential for megapacks made with domestic 4680 cells from Giga Nevada will be truly staggering. Exactly. The credits from these cells alone will be worth $4.5 billion annually once Tesla reaches 100 gigawatt hours of scale. And there is little reason to believe Tesla will stop ramping domestically once that factory is built out. Gigafactory Austin is ramping 4680 production already, and it will also qualify for these credits. These credits are pure margin and are likely to be a significant driver of earnings growth in this decade. And now onto energy services and software. By the way, guys, if you want to go a little bit deeper on this stuff, I did a deep dive into every one of these things maybe a year and a half ago. Just search Solving the Money Problem Tesla Energy. You'll find the video. While the bulk of the revenue opportunity for Tesla in the short term is undoubtedly in the hardware sales, services and software sales will play an increasingly important role in the longer term. As Tesla's hardware sales accelerate in the next decade, the company will have a stream of recurring revenue on the cumulative deployed base of assets. In other words, once Tesla sold a ton of stationary storage products, and I do mean a ton. If you guys don't know the metric system, a ton is a lot. Once Tesla has a ton of energy products available, sitting on top of those is the energy software. Over time, this will become a substantial money printer for Tesla. We believe that this revenue stream will warrant a high multiple in the long run due to its high margin nature, the fact that it is recurring and therefore relatively low risk, and the fact that it will be growing at a very high rate for a sustained period of time. One of these sources, maintenance contracts, again, you want to pause, read it all, go for your life, let's move ahead. While these payments are undoubtedly small today, when Tesla achieves scale, they will become more meaningful. For example, when Tesla has cumulatively deployed 1 terawatt hour of megapacks, remember, they're aiming for 3 terawatt hours per year of battery production in 2030. including vehicles and storage. So 1 terawatt hour, not that much in the scheme of things. The associated maintenance fees will be over $1 billion per year. Autobidder. Autobidder is a real-time trading and control platform that provides asset management and portfolio optimization. Autobidder connects data from real-time energy markets, which, by the way, are kind of like stock markets, commodities markets, the prices up, down, up, down, up, down constantly. Autobidder is like a high-frequency trading bot in the stock market, but for energy. Using machine learning and other techniques, Autobidder optimizes the financial performance of a site. While many providers offer this type of service, the decision logic of batteries is much more complicated than that of a typical power generating assets like a wind farm or natural gas power plant. In those cases, the cost of production is known and does not change throughout the day. As long as the market price for electricity is greater than the cost of production, the decision to sell is made. Things are a little bit more complicated when batteries enter the frame, but it also creates greater opportunities. If Tesla's in-house AI prowess can result in a better energy market platform than its competitors, spoiler alert, it will. No, really, it will. Which, again, Tesla has a better money printer than anyone else. In other words, you already have some stationary storage. If you use Tesla software, you're going to make more money from this existing asset than using somebody else's energy software. Again, you need to not have a brain to go, oh, let's make less money with somebody other than Tesla. And this really is an AI problem. Then this functionality alone could be a factor for Tesla winning bids for large stationary storage projects, in addition to generating revenue on the Autobidder service. Tesla also has the curiously named Power Hub, which reminds me of a website I've never visited in my life, microgrid controller, Opticaster, and virtual machine mode. Again, all of these I've covered in detail in my Tesla Energy video. Just search YouTube, you'll find it. A little bit more on services and margin potential. Fluence, a provider of grid-scale storage solutions, provides a breakdown of their revenues and contracted assets. In 2022, they reported contracted assets of 2 gigawatt hours. Remember, Tesla's new Megapack factory alone, fully ramped, will be 40 gigawatt hours per year and reported revenue of $16 million. This gives an indicated services price of $8.2 million per gigawatt hour of assets. Using this figure as a baseline, we can estimate that Tesla's energy services revenue for 2023 is approximately $500 million, or roughly 5% of the energy hardware sales. If you guys want to check out the battery value streams graphic over on the right here, we're just seeing that batteries can provide up to 13 services to 3 stakeholder groups. For example, down the bottom in blue, utility service, distribution deferral, transmission congestion relief, and resource adequacy. If you guys want to nerd it out, pause the video, go for your life. As can be seen in the graph, we assume that Tesla will deploy 90 gigawatt hours in 2025 and 669 gigawatt hours in 2030. We further estimate that pricing on a dollar per kilowatt hour basis will decline by 39% over this timeline. And as noted previously, EBITDA margins are projected to peak at 40% in 2025 before normalizing at 30% in 2030. Interestingly, by the way, these are bang in line with my own projections in my Tesla valuation model. I've got a long-term margin on these, give or take around that 30% mark. Not perfectly apples to apples, but we're in the same ballpark. When adding in services margin as described previously, we calculate total energy EBITDA of $15.8 billion in 2025 and $61.2 billion in 2030. For valuation purposes, we assume Tesla would reach around 4 million vehicles in 2025 and 12 million by 2030. Jumping in here, absurdly low. I get it. You want to be very conservative in your estimates, but absurdly low. To be fair, my 2025 estimate for Tesla deliveries in my base case, 4.1 million. So we're not too far off there. By mid-decade, fairly in line. However, by 2030, my base case is 15 million vehicles delivered. And again, this is the base case. Admittedly, I do have an optimism bias, but full disclosure, my bear case in 2025 is a smidge over 4 million units delivered. And my bear case in 2030 is over 12 million vehicles delivered. 12.8 as I record this. My bear case, by the way, has a 3% probability. Could happen, but I do think it's extremely unlikely. The point here, I think these estimates are actually extremely, potentially far too conservative. We assume EBITDA margins on the automotive hardware side of the business will decline to 20% in 2025 and 18% in 2030. However, it also seems probable to us that FSD sales will become increasingly material component of Tesla's overall financial results. They sure fucking will. We believe pricing will increase and the percentage of revenue which is deferred will be de minimis. Never heard that. I'm assuming it's Latin for the size of the brain of a typical Tesla short seller. Assuming price increases of $5,000 in 2025 and another $5,000 by 2030, and take rate increases of 20% in 2025 and 30% in 2030. Again, just for the record, I think these take rates are absurdly low. If Tesla solves autonomy before 2030, I have an exceedingly difficult time imagining a scenario in which just 30% of Tesla vehicles have autonomy activated. I think this take rate is going to be close to 100% once autonomy is solved, People have had time to get used to it. Might take a few years, but once autonomy is solved, demonstrably way safer than human drivers. Tesla robo-taxis are happening all over the place. People are going to sleep in their vehicle, waking up at their destination. At that point in time, I just can't fathom a scenario in which the vast majority of Tesla vehicles aren't running their FSD software. This would be like having a computer today that's running Windows 3.1, doesn't even have a graphical web browser. Why would you fail to unlock that extra functionality with the latest software? Doesn't make sense to me. We estimate FSD revenues of $16 billion in 2025 and $90 billion in 2030. And I estimate that these estimates will not age well. Then again, I could be wrong. Despite my persona, I'm not arrogant enough to think I know what's going to happen. But for real though, my base case estimates approximately double these numbers. Now on to advanced manufacturing credits. While it may seem strange to model out tax credits as a significant driver of value, the sheer magnitude of this benefit when calculated against Tesla's plans for storage warrant a separate calculation. We are only contemplating the combined $45 per kilowatt hour credit for domestically manufactured cells and models. As we know on Tesla's recent earnings call, CFO Zach Kirkhorn indicated that for 2023, Tesla anticipates earning $150 to $250 million per quarter, with that amount increasing over time, and that's just relating to the battery credits. Discounting these cash flows, we calculate a present value for the credits of $35 billion or $10 of valuation per share. Base case valuation. The projections described above result in an EBITDA of $59.3 billion in 2025 and $205.2 billion in 2030. EPS is $11.49 in 2025. Again, just jumping in here, way below my own estimates. My base case, $17 a share for 2025 as I record this, and $30.70 in 2030. My base case, literally 3 times this amount for 2030. The major discrepancy here is around FSD take rates. And again, if you've got access to my valuation model on Patreon, have a look at these slides yourself. As can be seen in the table to the right, this results in a base case valuation ranging from $287 per share to $354 per share. And just a quick caveat here, it is important to note that the scenario above leaves out upside optionality from new products which could drastically alter the share price of Tesla. Tesla's full self-driving software has been developed with the goal of enabling true autonomy, which would drastically alter the economic utility of Tesla's vehicles. Tesla's humanoid robot, named Optimus, which is currently in the early stages of development, could also drastically increase the utility offered to its customers. Robo-taxis would free up additional time for commuters, while the bot's TAM is in... Oh my god, I can't even say this because it's true and it's just so absurd. While the bot's total addressable market is the entirety of the worldwide labour market. Absurd as this sounds, it's accurate. Don't sleep on TeslaBot. Under the scenario in which Tesla truly solves autonomy, we believe they could price the software at around $50,000 while achieving effectively a 100% take rate on FSD. So here's where we diverge. In theory, it is technically possible that this software could be priced around $50,000 with a take rate of effectively 100%. And I actually agree, if Tesla does solve autonomy, the take rate will be effectively 100%, maybe 98.5, something like that. Again, shout out to my Tesla valuation model. You can see all of my take rates for FSD in every scenario right out till the end of the decade. Maybe I'm channeling my inner Wall Street dolt. I really struggle to see $50,000 for the software package as realistic. I think at some point it almost becomes an expectation, and sure, it will still attract a massive premium. My brain says yes, could happen, but my heart says no. Not very scientific, I know, but that's all I got to go on. Don't get me wrong though, I do actually believe over time, the price to purchase FSD, either outright or to subscribe, is going to increase. And I don't really have a logical reason as to why it can't get to $50,000, but it just doesn't feel right, which is completely illogical and an emotional reaction, but it's how I feel. This results in a present value for Tesla stock of $1,184 per share, as in today, assuming they solve autonomy and the software price goes up considerably, as in triples, which ain't that much. Tesla stock today worth about 6 times more than its current closing price. And finally, this figure excludes the potential of Tesla to earn recurring revenue as part of Tesla network. Yet, as drastic as this share price increase would be, we believe it could be dwarfed by the potential of Optimus. Yeah, so ladies and gentlemen, $1,184 per share for Tesla stock today, 6 times higher than current price, could potentially be dwarfed by the potential of Optimus. And if you're a regular viewer, you'll understand I agree with this entirely. Just want to read from the final paragraph here. Given the difference between our base case and the share price today, and the asymmetric return profile of the upside scenarios, we rate Tesla as our highest conviction investment at the moment. And just a quick look at the base case, the financial summary here. Vehicle sales in 2025, 4 million, 2030, 12. Average selling price in 2025, 40,000, which for the record is almost identical to mine As I record this, I'm at $39,813 ASP in 2025 in the base case, and in 2030, a $35,000 ASP. For the record, as I record this, my base case 2030 ASP, $32,463. Pretty close. There's a major divergence in FSD take rates and a lot of other things from there, but we'll leave those for another time. Oh yeah, don't forget, athleticgreens.com/SMR. Thank me later. Always good to look through research from other Tesla investors. It's clear as I record this that the majority of investors are sleeping on Tesla Energy, and that's putting it lightly. Because it's such a tiny speck today relative to Tesla's automotive business, most investors and analysts are completely ignoring it, myself included. Like I said, I'm still massively lowballing my own Tesla Energy estimates in my valuation model. But Tesla Energy has the potential to print insane profits for the company. And not just one-off sales on the hardware, but recurring, high-margin, almost pure profit revenue on the software, the energy software once deployed. The Inflation Reduction Act is also going to be throwing money at Tesla like you cannot believe. Billions upon billions upon billions of dollars every year for producing batteries domestically. There's also the EV credits, there's commercial credits. All entirely unnecessary. As I said, this stuff is all a commercial inevitability anyway, but as a Tesla investor, I will absolutely take it. And of course, the potential, if Tesla does successfully solve autonomy, makes everything else in Tesla's business look like a bad f***ing joke. Oh, and then there's Optimus Humanoid Robot, which, if successful, will make everything, including FSD/autonomy, look like a bad f***ing joke. That is really saying something. So, I think the moral of the story here, don't sleep on Tesla Energy, don't sleep on Tesla's autonomy, and don't sleep on the Tesla bot. Unless you want to wake up in a few decades' time realizing you missed out on one of the greatest opportunities potentially ever presented to retail investors. And while I'm warning you guys and girls about things to do now to avoid future regrets, I implore you, give Athletic Greens AG1 a go. Now, I know a lot of you guys are getting tired of hearing me pump this thing, but it's that f***ing good, I cannot help myself. But hey, today I've decided I'm not going to pump it. I'll let you guys do that for me. Cue testimonials, please. Thanks for all the AG1 pumps. You're welcome. I finally bought it about a month ago and have been taking it every morning since. And I cannot stress enough how amazing I feel. So amazing, this guy or girl can't even spell. That's how excited they are. Thank you. You're welcome. Another great video regarding Athletic Greens. I've now been taking it for around 3 weeks. I decided to try it after hearing you mention tiredness in the afternoons, which is something that has been plaguing me since late summer 2022. In the second week of taking AG1, I suddenly realized that the tiredness in the afternoons had gone. I'm also finding myself much more alert and active. This is the exact same experience I had. This is why I started ranting and raving about this to family and friends nearly 2 years ago. Had the same afternoon fatigue. Gone. And it ain't just me. And just one more, why not? I got AG1 like 2 weeks ago, and it is serious. I almost instantly, within 2 or 3 days, got way more energy, better mood, and workouts seem to be doing more/easier. I feel great. Hopefully, it continues. Seems almost too good to be true, but I haven't worked out after work in a long while. I do construction, and now I almost need to work out in order to sleep. It's great. Great suggestion, SMR. So, literally don't take my word for it. These are people who've heard me pumping this thing 24/7, non-stop, trying to help you guys, who said, you know what, I'm going to try it. What's the worst that can happen? 90-day money-back guarantee. And here are the results. So, you don't need to take my word for it. Take their word for it instead, please. If you want to feel and perform your best, increase your energy, try Athletic Greens, fill in your nutritional gaps. It's loaded with vitamins, minerals, whole food source nutrients, adaptogens, probiotics, prebiotics, enzymes to help with digestion, just about everything. You name it, so much bang for buck. And there's a 90-day money-back guarantee. So head to athleticgreens.com/SMR or use the link in the pinned comment, and hopefully in a few weeks' time, you'll be leaving me a comment like this as well. And FYI, we have now cracked 290 exclusive videos on Patreon, still counting rapidly. So if you're not a member, you can join with the card in the corner or the link in the pinned comment, and I'll see you over there. Love ya.